So let's take the discussion forward with Jigar to understand more on the markets. Jigar, thank you so much for joining in with us this afternoon on ET Now. And, like I was talking about the Nifty 50, right? Like we saw it at 19,800 levels, then corrected how? That it's now below the 19,700. Today also trying to make that recovery. But what is the view now going forward in terms of the Nifty? Where do we see it headed?
Yeah, good afternoon. Thank you as always for inviting me to your show. Uh, I think, we have sort of had these issues and pendulum swings, which increasingly are getting very difficult to, estimate on where we are heading. But if we break the discussion down in two or three segments, it becomes a little more apparent as to why things are so choppy, right? First, very clearly, the macro situation doesn't look like it's improving in a hurry. All of us talked about how the bond inclusion will bring in $24 billion in the first year. But if you see the movement of crude from the lows of June, then that itself will take away more than that, right? So a $20 crude movement with a 1.7 billion sort of barrels of annual imports, you are going to pay on the balance of payment a very large sum, even when you look at in comparison to the JP Morgan flows. Now, secondly, the Fed fund target rate and the repo differential at 100 basis points is really very low. So I think that situation can bring in some amount of additional pressures on the forex reserves at the time when it doesn't look like the situation where the rates, especially in the US, are likely to come down in a hurry. So all said, I think sort of we have had a great run since March, especially in the small and mid caps per se. But it's time to at least be a little more watchful. Position the portfolios. Everybody is looking for the next round of multi-baggers. But I think the time to dial up risk in the portfolio could come later in the year rather than going hunting just right now.
Okay, so not dialing up that risk profile right now, that will come later. But let's talk about the defensives of sorts. And I'm talking about financials. It had become a bit of a defensive because there was quite a bit of visibility on growth. But if you look at the earnings from, let's say, HDFC Bank, IndusInd Bank, Bajaj Finance, it wasn't bad. But we are not seeing that, buying interest come back in the financials. What do you think explains that? And would you be a buyer in financials?
So I think part of this explains, Anisha, is that if you look at the top 10 overweight stocks from the FI portfolio, six of them are banks, right? So whenever a globally coordinated sort of interest rate hike happens, not only sort of does the valuation of banks increase because they reprice their assets much faster than liabilities, but also capital moves out of the country, right? It moves out of all risky assets, which includes emerging markets, which includes India. And therefore, you have this situation where the value of the underlying asset is rising, but the largest shareholder, which is the FI, is still forced to sell it. Now, we have seen this similar story play out in the last quarter of the calendar year 2021. And then 2022, we saw how well the financials rallied. I think we are in a similar time zone, period of time rather as we speak this. You might have a situation where because FIs are sort of exiting, reducing their exposure to India, they will sell what they own. They can only sell what they do own. But then there will be a time when the share prices will catch up to fundamentals. And in comparison to the other sort of run-ups that we have seen, especially in the small and mid-cap space, financials are still offered to us at a valuation that do make a reasonably decent sense. So yeah, to answer your second question, we are increasing exposure in the entire BFSI space.
Sure. And Jigar, if I can, kind of lure into talking stock specific stuff as well, because I do remember some of your favorites like, Satin Credit Care was something which was there in your portfolio. You also had Archean Chemicals as well as, if I have it right, Anthony Waste as well. You were talking positively about. What have been the recent additions in your portfolio? Anything that you have picked up in the mid cap, small cap arena?
Not really. Actually, see, over the course of the past, we were almost 60% as a portfolio, 50% small cap, 10% mid cap in the month of March 2023. And if you look at our portfolio on the most recent month, that exposure from 60% has come down closer to 35%. We intend to bring it down further to 30% as the rally continues. So if anything, we are sort of pruning exposure in that space rather than adding more. Life insurance, banking, all of those make a lot of more sense. Pharmaceuticals as well continue to make a lot more sense, but nothing really we have added in the small cap space per se.
Right. Jigar, you were mentioning in terms of pharma as well as what are you looking at in terms of pharma if you're liking there? Is it more on the mid-cap side pharma companies that you're looking at? And also in terms of IT, today look at the move coming in for some of those mid-cap IT names as well. Anything interesting that you would look at in terms of IT given that we've seen the correction coming in for such a long time there?
Yes, so IT is sort of it's one of those zones, right? It is people think it's neither expensive nor cheap, but the growth is not really there. So what do you do with a space like this? Within that broader bucket, I think people are finding niches wherever they can, and those we do own a few of small slash mid cap IT names, but I think that's where the entire presence is. Now, I think where a lot of confusion emanates from is the fact that India doesn't really have tech, right? We have IT services. Now, unlike a NASDAQ tech, say for example, Zoom, revenue can sort of, increase any given pandemic. That's not really the case with the large cap Indian IT names. So then you saw them rally in line with NASDAQ in the 2021, so post-COVID rally. And therefore, when you compare on a 5-year basis, the valuation looks appealing. But if you look at the growth in 2019, with most of these companies were reporting versus the growth that what most of them are now guiding, there is a very decisive slowdown. So my argument is that whether to pay a valuation that equates to a 5-year average is a very large debate. And therefore, large cap IT per se is still not making the cut for us. Again, stock specific issues for a few of them as well. But on a broader scale, it's not making a lot of sense. Small cap IT does sort of indeed have some amount of going through. On the pharma space, I think we had written an article in I think April where we highlighted that the US generic space seems like it is bottoming out fairly well. It's a multi-year, since 2017, you have had a number of factors where things didn't align very well for them. And you're trying to see the rate of fall in prices. You're not really seeing prices rising for a lot of these US generic companies. But the end of a very bad cycle is still reasonably decent news. So we have some exposure there. Still looking out for.